The ticker tape machines began to chatter with a frantic rhythm that drowned out the murmurs of the trading floor, marking the exact moment when confidence evaporated into panic. It was October 1929, and the air in New York City grew heavy with the scent of burning paper and the metallic taste of fear as fortunes dissolved in real time. Men in wool suits clutched telegrams like lifelines, watching numbers tumble down the board with a speed that defied the logic of the previous decade's endless boom. This was not merely a correction in asset prices, but a fundamental fracture in the global financial architecture that had been painstakingly built since the end of the Great War. Today, the silence is different, digital rather than mechanical, but the underlying tension vibrating through the global economy feels hauntingly familiar to those who study the scars of history. We are witnessing a convergence of debt cycles, geopolitical fragmentation, and monetary experimentation that mirrors the precarious setup of the late 1920s. The patterns are not identical, for history never repeats itself with perfect precision, but the rhythmic echoes of leverage and liquidity are becoming impossible to ignore for any serious observer of markets. The stakes of this comparison extend far beyond the valuation of stocks or the performance of a specific index over a quarterly reporting period. We are confronting the stability of the sovereign debt market, the integrity of the currency reserve system, and the social contract that holds modern economies together during periods of extreme stress. Central banks around the world have expanded their balance sheets to unprecedented levels, injecting liquidity into the system to prevent collapse during crises that seemed insurmountable at the time. This intervention has created a moral hazard where risk is socialized while profits remain privatized, distorting the price signals that normally guide capital allocation efficiently. Investors today are operating in an environment where asset prices are disconnected from underlying earnings growth, driven instead by the promise of endless monetary support from Federal Reserves. The danger lies not in the inevitable correction itself, but in the systemic fragility that has accumulated beneath the surface of apparent stability during the years of easy money. If the mechanism that props up these valuations fails, the reversal could be swift and devastating for households that have tied their retirement security to inflated market indices. To understand the gravity of the present moment, we must rewind to the Roaring Twenties, a decade characterized by technological euphoria and a widespread belief that business cycles had been permanently conquered. The introduction of radio, the electrification of homes, and the mass production of automobiles created a genuine sense of a new era, much like the digital revolution and artificial intelligence boom of our current time. Charles Mitchell, the head of National City Bank, famously declared that there was nothing to worry about, embodying the hubris of a financial elite that believed they had mastered the mechanics of wealth creation. Margin debt soared as ordinary citizens borrowed heavily to buy shares, convinced that the upward trajectory of the market was a law of nature rather than a cyclical phenomenon. The Federal Reserve, led by the influential Benjamin Strong, had kept interest rates low to help the Bank of England maintain the gold standard, inadvertently fueling a speculative bubble in American equities. This policy decision prioritized international currency stability over domestic financial health, a trade-off that mirrors the geopolitical compromises seen in modern central banking coordination. When Strong died unexpectedly in 1928, the stewardship of the global financial system lost its most capable guardian, leaving a vacuum of leadership just as the cracks began to show. The narrative of the crash is often reduced to a single week in October, but the seeds were sown years earlier through the complex interplay of war reparations and gold flows between nations. Following the First World War, the United States emerged as the world's creditor while Europe lay devastated and indebted, creating a structural imbalance in global trade and capital flows. The Dawes Plan and subsequent Young Plan attempted to manage German reparations by looping American loans through Europe, creating a circular flow of capital that was inherently unstable. If American lending stopped, the European economies would collapse, and if Europe collapsed, American exports would vanish, creating a deadlock that relied on perpetual confidence. Montague Norman of the Bank of England and Benjamin Strong of the Federal Reserve worked closely to manage these flows, often operating outside of public scrutiny to maintain the illusion of stability. Their cooperation was essential to keep the gold standard functioning, but it required suppressing interest rates in the United States, even as inflationary pressures began to build domestically. This historical episode reveals how geopolitical necessities can force central banks into policies that undermine long-term economic stability for the sake of short-term order. The economic mechanism behind such crashes is rooted in that credit cycle, where expansion leads to overleveraging, followed by a painful contraction when debt servicing becomes unsustainable. In the 1920s, the leverage was visible in margin accounts, but today it is embedded in complex derivative structures and shadow banking systems that are less transparent to regulators. When asset prices rise, collateral values increase, allowing borrowers to take on more debt, which in turn drives prices higher in a self-reinforcing feedback loop. This cycle continues until the income generated by the assets fails to cover the interest payments, at which point the music stops and the scramble for liquidity begins. The modern financial system adds layers of complexity through high-frequency trading and algorithmic risk management, which can accelerate sell-offs during periods of volatility rather than dampening them. Liquidity, which appears abundant during the boom phase, can vanish instantaneously when counterparties lose trust in each other's solvency, freezing the plumbing of the financial system. Understanding this mechanism is crucial because it explains why crashes are not random events, but the inevitable result of excessive credit expansion relative to real economic growth. Drawing a parallel to today, we see similar concentrations of wealth and asset inflation driven by prolonged periods of near-zero interest rates and quantitative easing. The top percentile of wealth holders own a disproportionate share of equities, meaning that market corrections have outsized effects on aggregate demand when confidence wavers among the wealthy. Corporate debt levels have reached historic highs, with many companies relying on refinancing to survive rather than generating sufficient free cash flow from operations. The proliferation of passive investing has further distorted price discovery as capital flows into index funds regardless of the underlying valuation of the constituent companies. Geopolitically, the world is fragmenting into competing blocs, reminiscent of the trade wars and protectionist policies that exacerbated the Great Depression after the initial crash. Supply chains are being rewired for security rather than efficiency, which introduces inflationary pressures that central banks must fight while simultaneously trying to support growth. This stagflationary environment limits the policy tools available to regulators, trapping them between the rock of inflation and the hard place of economic contraction. Hidden within this structure are the power dynamics of institutions like the Bank for International Settlements and the major commercial banks that act as primary dealers for government debt. These entities operate with a level of insulation from public accountability that allows them to manage crises through back channels and liquidity swaps rather than transparent market mechanisms. The incentives for these institutions are aligned toward preserving the system itself, even if doing so requires transferring wealth from savers to borrowers through financial repression and inflation. Governments benefit from this arrangement because it allows them to finance deficits at manageable rates, but the long-term cost is the erosion of currency purchasing power for the average citizen. There is no conspiracy in this observation, only the rational behavior of large organizations seeking to survive within the rules of the current monetary framework. The alignment of interests between the Treasury, the Federal Reserve, and the primary banking sector creates a unified front that prioritizes stability over fairness or market purity. Recognizing these incentives helps explain why policy responses often seem disconnected from the economic reality experienced by households struggling with cost of living increases. The acceleration phase of this cycle is becoming visible through the inversion of the yield curve, a historical predictor of recession that has maintained a strong track record over the past 50 years. Commercial real estate faces a reckoning as remote work trends reduce demand for office space, threatening the balance sheets of regional banks heavily exposed to property loans. Sovereign debt loads in developed nations have reached levels that historically precede either default, inflation, or financial repression to manage the burden. Interest rates, having been raised to combat inflation, are now increasing the cost of servicing this debt, creating a fiscal drag that slows economic growth precisely when resilience is needed. The labor market remains tight, but layoffs in the technology and finance sectors suggest that corporate leadership is preparing for a downturn by trimming costs preemptively. Consumer savings accumulated during the pandemic stimulus period are dwindling, leaving households more vulnerable to shocks in income or unexpected expenses. These data points form a mosaic of fragility that suggests the system is losing its ability to absorb shocks without significant disruption to asset prices. The climax of this narrative arrives when the market realizes that the central bank can no longer support both the currency and the asset market simultaneously. This is the moment of revelation where the illusion of infinite liquidity is shattered by the hard constraints of inflation and currency debasement. Investors will be forced to choose between holding cash that is losing value or assets that are falling in price, a dilemma that drives volatility to extreme levels. The big truth that viewers must understand is that the crash is not the event itself, but the recognition that the underlying value of paper claims exceeds the real productive capacity of the economy. Wealth is not destroyed in a crash, but rather redistributed from those who hold leveraged paper assets to those who hold real productive resources or debt-free capital. This transition is painful and often violent in economic terms, leading to business failures and unemployment that ripple through communities for years. The policy response will likely involve massive fiscal stimulus and monetary expansion, which may stabilize prices temporarily, but will deepen the long-term structural issues of debt and dependency. In the end, History grounds us in the reality that economies are organic systems that go through seasons of growth and decay, regardless of human intervention. The 1929 crash led to a decade of hardship, but also resulted in structural reforms like the Glass-Steagall Act and the creation of the SEC to restore trust in markets. Today's challenge is to navigate the transition without resorting to the protectionism and conflict that turned the Great Depression into a global catastrophe. We stand at a crossroads where the decisions made by policymakers in the next few years will determine the trajectory of the global order for the next generation. Resilience will come from diversification, debt reduction, and a focus on real value creation rather than financial engineering. The pattern is back, but the outcome is not written in stone, leaving room for agency and preparation among those who understand the forces at play. We must look beyond the noise of daily headlines and focus on the deep currents of credit and confidence that truly drive the economic world. If you seek clarity amidst the chaos of modern finance, consider subscribing to this channel for deeper analysis.